What's up, Danny?
Try not to choke and die.
Yeah, that's always a good thing. If you can start your morning without choking and dying, I think you're in the plus, right? What should you do with $10,000 in cash, Danny?
First and foremost, you're going to want to go to your local casino and you put it on black or red. You will then have doubled your money or lost it all. And then you invest it.
You might as well. You might as
Right?
well.
It's pretty bad. No. So with $10,000, what I will say first and foremost, we kind of touched base on it last episode, is you don't want to deploy all your capital because then you don't have any flexibility. The most you can do at that point is sell. You don't want to sell when things are dropping in value and realize a loss unless you need to or really want to. But you want to have some cash available to take advantage of discounted prices. So with 10, it affords you the flexibility to have a little bit better diversification, more positions, and still leave some cash on the sidelines to deploy at that point when prices are agreeable.
How much for our sake? Like 5,000 or so, or?
Yeah, I would say maybe 60, at most like 70%. And then you want to have some money so that you can take advantage. And even if you're buying more of the same stocks you bought initially, you will improve your average price on them by buying them at a lower price.
Okay. All right. So let's get right into it. Which stocks should you get your hands wet with here?
All right, we'll start off with safe and secure here. JP Morgan has a solid dividend, big bank, biggest one I think right now of all of them right now that are publicly traded domestically. It's a very good, solid long-term hold. I would expect this to head back towards into the low 100s, 110, 120 over the next year. I have 6 that I'm going to recommend in this video. I would recommend about $1,000 or a little bit less into each one to leave that ideal like 40% cash on the sideline right now. Secondly, we'll touch base with Geo Group. It's a REIT. It says healthcare, and to an extent it is, I guess. They're actually just a prison operator. So I like it because it has a very high dividend, and the customer base tends to be pretty consistent about showing up and staying there. In a recession, people are still going to be in jail. It's pretty consistent revenue stream, I should say, at that point. Yeah, it makes you feel a little dirty when you're talking about the prison industry. It's kind of like buying alcohol or tobacco stocks. But they are a business. They provide a service, and they actually do most of their work with states over long-term contracts, and they actually agree to run the prisons on behalf of the state, and that's how they make their money. So thirdly, we'll touch base with waste management. A lot of people are familiar with it. They just collect and handle garbage for a lot of municipalities. So it's also a very recession-proof stock where people are still going to have garbage and it's still going to have to be collected and sorted and disposed of. So it's another, at least it pays a dividend. It's not huge, but you'll at least have a little bit of a cash return coming into your account at that point as well. Fourthly, we'll touch base with Prudential, another decent little dividend and also pretty recession-proof. They're in life insurance and insurance in general for underwriting. And those are things that typically people will end up owning regardless of how the economy is doing on the whole. Some may reduce their life insurance policies or cancel them in the meantime, but the majority of their clients will stick around and keep paying their premiums. Second to last year, we've got Kinder Morgan. This one has more upside than the other ones I've touched base on. They are a pipeline operator, so they are in the business of transporting oil and natural gas across the U.S. for export, or just to get it from an oil field to a refiner. So it's more of a utility stock really than it is a pure oil play. And it also has a very good dividend. I really like this stock because one of the founders, his last name is actually Kinder, has been buying quite a bit of this, as you'll see here. Richard Kinder himself, most recently, March 11th, he bought only an extra $7 million worth of the stock after buying $5.8 million 6 days prior to that. So he's pretty confident in this stock at levels actually above the current trading price as well. You want to see that when an insider's buying it and you can get it for less than them, that's a pretty good sign. And Mr. Kinder has deep pockets given how much he's buying of this stock. So that's a good sign. Lastly, we'll touch base on another one with very good upside. I think over the long term, I would expect this stock to more than likely get close to doubling in value in about the next 5-10 years. And that's Wynn Resorts, casino and hotel operator in Vegas and Macau primarily. The dividend's pretty high. That might not be sustainable in the near term. They may suspend it just to save some money because things are so in flux right now with this pandemic that's ongoing. But long term, like I said, it's probably heading back into the mid-hundreds. So there's good upside there. So the stock market right now is only about 15% below the most expensive levels in the history of mankind. So that's why I recommend that you don't deploy all of your capital, whether it be $10,000, $1,000, or $1 million. you want to have capital available to take advantage of lower prices. So a month ago at the lows, it was 34% off of that all-time expensive price. And ideally, you want to wait till it gets a little bit close to that level. It might end up below that level where you're looking at 40 or 50% below the all-time high prices. And then you'll be very thankful for having some cash deployable, ready to deploy at that time.
All right, guys. So that pretty much sums up our first season of just getting into stocks. What we're going to dive into next is Danny's favorite topic, options.
So with options, you can actually, I like it because you can actually bracket your risk and say, you know what, I'm willing to risk $500, and the percentage returns are a lot higher than stocks. Where there are trades where you can say, I don't think this stock's going to go above 20% above its current price, and if it does, fine, I'll lose $400 or $500. If it doesn't, you will make $100 or $200. So on your risk, you're looking at 20 to 40% returns in a matter of 2 to 3 weeks. So it's a way of having a very defined risk and actually higher returns because options afford a lot more leverage as well.
So stay tuned for all that good stuff. If you've gotten this far in the video, please subscribe and like. It helps us out a lot. And until next time, we will see you guys, and best of luck to you.